Assalamu alaikum. Hello, everyone. Uh, this lecture is regarding the short selling, its concepts and calculations. I thought of making this video for those who are not very comfortable with the descriptive form of lectures. So, this might help you, and I shall be creating more videos for our upcoming lectures, and I shall be sharing with you accordingly. So, this is the first video. Uh, about short selling, its basic concept, and what kind of calculations we can do in this concept. So let's have a brief overview of what short selling is. Uh, Short selling is a phenomenon in investment or capital market where an investor thinks that there is a particular stock or share of a company who is overvalued and he doesn't own the shares at the moment. Fine, this is important. In short selling, the investor doesn't usually own the shares, but he is witnessing a share in the market that whose value is very much high and is going to go down in certain number of days or coming days. So he thinks, why not exploit this opportunity by selling the share at a higher price today and then buy it back again after some days at a lower price. So what happens is that he asks his broker to short sell certain companies' shares for his sake, and he sells them in the market. The broker sells them in the market at the current price. But the point to note is that the amount or the proceeds from the sale of those securities is not credited to the investor's account because he has a liability to pay in the form of shares. It's not his shares, he has taken from someone else. So, as long as he's not returning back the shares, the amount is not going to be credited to his account. And if your hunch is right, after certain days, the price really goes down. So, you can ask your broker again to buy them back, the shares, and you can return the shares to the person from whom you had taken it previously, and the difference between the two prices is credited to your account net of invest brokers commission and cost, of course. So a simple example of all these discussion will help you better. So let's say there's a stock by the name ABC and whose current price is, let's say, $100. Fine. So this is overvalued. You think the investor thinks that this price is high and the price is going to be 80 in a coming day in the next 2 days. So he asked his broker to short sell this ABC. So the broker sells this share at the prevailing market price. So the proceeds from this sale is 100. And let's say if you are absolutely right, and after 2 days the price again comes to, let's say you're right and it goes to 80, so you buy it back at 80 and still you can have a profit of 20. Of course, I'm ignoring at the moment the brokerage costs and commissions. So this 20 is then credited to the investor's account. Fine. But since it's a speculation that the price may go down, so future is uncertain, the price may also go up. So in that case, let's say instead of decreasing, the price goes to 110. So in that case, you will have a loss. Okay, but you need to buy the shares back even at the higher price because you have to specify the timing upon which you will be closing your position. So no matter what the price is, you have to buy it back because you have to return those securities to the person. And another point to note is that you must pay the dividends and other benefits the owner of the securities receives. Now, during this whole time, when you are doing short selling, uh, since these shares are not yours, the person who is doing short selling, you have borrowed those shares from someone else. So if during this 2 3 days, if there is a dividend declared or dividend is declared, fine. This is again your responsibility, the person who is doing short selling, to pay the dividends also to the person or the investor from whom you have taken the shares. Fine. So this is the basic concept of short selling. In the coming slides, I'll be telling you about its calculation, what kind of calculations we can do, how to calculate the rate of return, the price limits, and the calculation of initial margins. Now let's solve a question regarding short selling. This is an example. Suppose that you are bearish on an IBM stock. Now this is how you can recognize a short selling question. Whenever you see the term bearish or pessimistic, that means the investor is having a pessimistic or negative view regarding a stock about its price, that it is going to go down in coming days. So this is an IBM stock. Its current market price is $120 per share. So I'm highlighting all the relevant data. You tell your broker to sell short 100 shares. The broker borrows 100 shares either from another customer's account or from another broker. Suppose the broker has a 50% margin requirement on short sales. Calculate the rate of return if the price falls to $60. Now, in these type of questions, we can solve for three things. Number one, the initial margin, or simply the margin or investor equity, which we call. Number two, the rate of return. And number three, the price limit. So to this we will come later on. First talk about the initial margin calculation and the rate of return, how it is calculated in a short selling question. Now let's calculate the initial margin first. You say in short selling, as the question says that the broker has a 50% margin. Now this is the percentage which is applied on the worth of shares which are short sold. Now, as the question says that we have 1,000 shares and each share is worth $120, so the total value we can calculate to be 120 is the share price into 1,000 shares. So that makes 1,20,000 as the value of the shares which are short sold. Now 50% margin. So what happens in short selling is the broker asks for a security in advance from the investor who is doing the short selling, and it has certain percentage. So 50% of the total amount in this question, that makes 60,000, because the half of 120,000 is 60,000. So that means the initial margin is 60,000. So since this is a very simple percentage, so we can calculate without any difficulty. However, there is a formula for margin as well. So now our account is having a combination of two values, 1,20,000 plus 60,000 as a percentage of the initial margin. So that means the total amount in the investor's account is now 1,80,000. So 120,000 plus 60,000, that gives us 1,80,000. So this is the amount currently present in the investor's account. Now from this value, how can we go back to the 50% margin if we are required to find the margin? So the formula which we can use for margin is, I'm writing it here. So total value in account, including the value of investor's equity, minus value of shares short sold, whole divided by value of shares short sold, right? So I'm gonna erase this side. Okay, so Based on this formula, what is the total value in account? That makes 1,80,000, which we have just calculated, minus value of the shares which are short sold, which is 1,20,000, whole divided by again value of the shares short sold, that gives us again 1,20,000. So it gives us 50% because the numerator will give you 60,000, 1 lakh 80 minus 1 lakh 20, and if you divide 60,000 by 1 lakh 20, that gives us 50%. So this is how we can calculate the margin percentage. Why we are interested in this calculation? This because this formula will be used in the price limit which we have discussed previously. So this formula is going to help you in finding out the price limit before you get a margin call. So this is how you calculate the initial margin. Now let's go back to the second point, which is the rate of return. How do we calculate the rate of return? So the second point regarding the question is finding the rate of return. Okay, so we now know that the current value as of now is 1,20,000, which is the amount of shares which are short sold. Now the question says calculate the rate of return if the price falls to $60. Now apparently it seems that we are going to have some profit because we already sold a share at 120 and now the share price has fallen to $60. So apparently it's something which we are seeing a positive thing. So how much did we earn in terms of percentage as a required rate of as a return? So uh, the formula for return is equal to value of shares short sold minus current value of shares whole divided by investors equity or initial margin. So remember, regarding the return, you always need to divide by initial margin. How much investor put initially and how much did you earn based on that initial margin? So based on this formula, let's put values in this. So value of shares short sold is 1 lakh 20 minus current value of shares. Now each share is worth $60. So the same 1,000 shares now can be bought with the $60 per share and they can be returned and we can pay the liability. So now each share is of worth $60. So the whole value of shares now becomes 60,000. This is how did we get to 60 multiplied by 1,000? Fine. So 1 lakh 20 minus 60,000. And how much did we put as initial margin initially? That was again 60,000. This shows that we have earned 100% over our return, over our equity, because 1 lakh 20 less 60,000, that gives us 60,000. And we initially invested 60,000 and we are also earning 60,000. That means we are getting 100% return. So this is how we calculate the required rate of return. And similarly, the more the price falls, let's say if this value, if it keeps on decreasing, so our rate of return will increase. Fine. So because this value is fixed, this is the amount which you already uh, got into your account by selling the shares. So this value is not going to get changed. So anything happens to this price, which is 60, the more it is decreasing, the more you're getting the return. Okay, so now the last part, which is finding the price limit. So let's, okay, so how high can the price of the stock go before you get a margin call if the maintenance margin is 30%? Now, what happens is just like discussed, that if this price keeps on decreasing, the investor gets the profit. However, if this price instead of decreasing, if it goes up, so our profit margin or our rate of return decreases. If you remember the numerator, which was 1,20,000 minus 60,000. So instead of, if this price is decreasing, instead of decreasing, if this price keeps on increasing, so the difference between these two values is getting more and more thinner. That means the rate of return is decreasing. And it might be possible that this price even exceeds, this value might even get exceeding, or it exceeds this value. So in that way, our rate of return can even be negative. So in order to prevent that, the margin, we have another margin which the broker sets, we call it as a maintenance margin, so that it is a margin before which an investor's amount or investor's equity should not go below. So as the question says, that how high the price can go before you get a margin call. So we can find that price limit also, after which we can receive a margin call and we have to deposit again the margin. So if you remember the margin formula that we calculated, which was margin is equal to total value in the account minus value of shares short sold divided by value of shares short sold. Now we can use the same formula to find that price. See how it is done. We already know that maintenance margin is 30%. Fine. So we can set the left hand side to be 30% or 0.3. Total value in the account, this is, we already know, 1,80,000 minus, since we are interested in the price, value of the share short sold. Now we know there are a number of shares, 1,000 shares, but we don't know the price. So instead of this value, I can write my this value to be 1,000 into P. And this P can be anything because this is the price in which I'm interested. Fine. And again, divided over again the value of shares short sold. So again, I can say 1,000 into price. And this is the price in which we are interested. Now it's simply an algebra. We have to isolate the P and then we can find the price before which we can receive a margin call. So if you simplify this formula, or if you can arrange for P, so you will get a value equal to 138.46. This is the value of price. This means this is the price, the highest level of price which it can attain before you will receive a margin call. And we can cross check this also. If I put the value of this 138.46 back into the formula, I should get the same 30%. So let's check this out also. So margin is equal to 1,80,000 minus. Now, since each share is of worth 138.46 and I have 1,000 shares, so my total value becomes 138,460 divided by the same value 138,460, and you get approximately 30% again. So this is how you can cross check also. This means this is the maintenance margin which is written here. So we have achieved. So the price may attain 138.46, and even if it increases by a single dollar, If it becomes 139, so the investor will get a margin call. So these are the calculation things which you need to know while solving the short selling questions. If you have any questions, you can post it through comments, and I will be more than happy to answer those. Thank you for now.